Welcome to the TrestleBridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, managing partner with TrestleBridge. And for today's call, we're going to focus on the tactical ETF strategies that we manage on your behalf. The goal for today, shed some context and insight into both the why and how the portfolios were developed the way that they were, with the thought process being this will then allow us going forward to better communicate not only how they were positioned, but more importantly, how they performed relative to what took place in capital markets. Now, before we get started, have a few quick words from our legal team. With that, we can go ahead, dive right in, and I want to start by taking a step back, offering some context with respect to the landscape of investing. It would likely take several dozen lifetimes to go through all of the different strategies, the techniques and approaches. That's then further complicated when we think about all of the different asset classes, the different types of securities, and the millions and millions of underlying investment vehicles. Now, prior to joining TrestleBridge, I spent roughly a decade as an investment consultant, working with some of the largest financial advisor teams in the Northeast. And in that role, my focus was to help coach them develop and implement their investment process, to think about how they position portfolios, and more importantly, how they would evolve those portfolios in response to changing market conditions. And having worked with thousands of financial advisors, in that experience, I came to learn there are two fundamental truths with respect to investing. The first is that there is no single strategy or approach that works best in all market environments. And just as markets ebb and flow, so too do different styles coming in and out of favor. This is the argument supporting the case for diversification. I would jokingly say to my advisors, if there was one strategy that worked best in all market environments, there probably wouldn't be multiple ways to do it. The second truth is that for all of the strategies available, if you're managing against a benchmark, at the end of the day, there are only three ways to outperform or generate excess return. And that's having the correct focus on risk, the factor and style allocation, and implementation. And based on these two principles, at TrestleBridge, we've elected to solve for the investment needs of our clients by employing a combination of the three focuses mentioned above. This is referred to as a core satellite approach, where we blend a combination of core holdings with more tactical satellite positions, those that are traded actively in response or in anticipation to changing market conditions. Now, the core holdings are a collection of ETFs and in some cases individual stocks. They represent roughly 60% of the portfolio, and they're not designed to be traded in response to changing market conditions, but rather to be held throughout longer periods of time. The emphasis for these positions is they screen for attractive fundamentals and long-term growth potential. In the end of the day, how they generate or aim to generate excess return relative to benchmarks is through what's referred to as implementation. Implementation, ultimately, at the end of the day, is the argument, instead of owning all of these stocks in a particular index, rather applying some criteria to identify those names that are going to be most attractive and ultimately rewarded by market participants. So to bring this to light, I want to share an example here. I'm going to go back to calendar year 2020. This was the year of coronavirus, obviously wreaked havoc on the global health system as well as capital markets. And I started here, I sorted all of the names in the S&P 500 alphabetically, and I just isolated the first 25. If you were to allocate equally to the first 25 names in the S&P 500, you would see in calendar year 2020, you would have generated a return of 21%. That's illustrated there on the bottom left column. However, if you applied some fairly simple fundamental screens, things like earnings growth estimates to identify those companies that are poised to grow their profits at quicker rates relative to their peers, and hypothetically, you applied that screen to avoid the bottom 20%, or in this case, the lowest 5 ranking stocks. As a result, if you allocated equally to the top 20 as opposed to the 25, you see your performance would jump nearly 50%, increasing from 21 to 29. The thought process with our core holdings here, although we're not trading these in response to day-to-day changes in market conditions, we're trying to be very thoughtful, thinking about what are those proven attributes, stocks that tend to outperform longer term, and isolating those exposures as opposed to owning broad indices. With that being said, where there is opportunity to generate excess return as markets can move, and in many cases move very swiftly, we've created 2 satellite sleeves, again, that are actively traded as market conditions evolve. The first has a dedicated mandate towards risk management. The second emphasizes both style and factor allocations. And again, to bring those to life, I want to share 2 examples with you. The first, when we think about risk, this is one of the most common questions we get. If volatility ensues, is this the time to take cash out of the market, put it under the mattress? And the argument against that is that long-term, the S&P 500, if we go back over the last century or so, on average, has returned to investors an annual figure just shy of 10%. Now you can see that is roughly 3% more than global bonds, although as highlighted in the right-hand column there, does come with elevated risk. So when you think about, on average, investors earning roughly 10% in the stock market in a given year, that is the argument that many make, including the Warren Buffetts of the world, to stay fully invested. However, when we do think about extreme volatile conditions, there certainly is an opportunity to create a smoother ride by taking risk off of the table. And so to bring that example to light, I want to go back to 2020. And as you see here on the left-hand side of the page, I have a graph of the S&P 500. If you had invested on January 1st of that year, did not trade throughout the course of the year, despite all of the volatility, on December 31st, you would have earned a return just north of 18%. However, as we see on the second graph, in mid-February, if you were able to correctly anticipate that COVID may have a negative impact on capital markets, you sold out of the stock market and then had the wherewithal on March 23rd at the absolute bottom to get back in, your return experience would have been roughly 3 times that. Now, it is virtually impossible to correctly time the exact entry and exit points for tactically trading markets. However, when research suggests there is a very high conviction or high probability of volatility on the horizon, there is an argument to be made for taking a portion of a portfolio, investing that more conservatively in order to have a smoother ride on the downside or better protect capital during volatile periods that then allows you to reinvest at lower prices. And given the benefit or the opportunity of employing this strategy, this is one of the sleeves we include in our satellite portion. The next, as I mentioned, focuses on style or factor allocation. And so I want to share here a graph of performance through last year market volatility. This is a Morningstar style box, and it categorizes stocks based on their style and their size. When we look vertically going left to right, we have value stocks. Those tend to be more of the slow and steady names. On the right-hand side, the growth-oriented tend to be more boom or bust. As we can see in this graph here, last year, value names held up considerably better than their growth counterparts. Furthermore, we think about the S&P 500 that lives right in the large cap blend space. That was down nearly 18%. And so when we think about being able to correctly identify the decision to own value versus growth or large cap versus small, assuming your research can correctly understand and anticipate where the market environment is going, again, at the end of the day, there is opportunity to add significant excess return by correctly identifying how a portfolio should be positioned. As a result, this is that last or second sleeve within our satellite portion that represents about 20% of the tactical portfolios. Now, we covered a lot of ground. I certainly hope that this was helpful. As always, would encourage you to direct any questions or comments directly to myself. And with that said, do want to thank you for your time and attention today. Have a great rest of the day. Take care.